Imagine waking up one morning to find your investments wiped out overnight. Sounds impossible? Well, the truth is the stock market crash has already begun, and most people haven't even noticed. In fact, recent reports show that over 60% of stocks are already in decline, quietly eroding your savings. If you want to protect your money and stay ahead of the chaos, you need to act now. Don't wait until it's too late. Like and subscribe for more insights, because understanding the signs early could save you thousands. Now let me show you why this is so urgent and what you need to know before starting. The stock market crash has already started. You just didn't notice. In this presentation, we will explore the subtle signs that indicate a financial downturn is unfolding beneath the surface. Many investors remain unaware because the decline isn't dramatic or obvious. Instead, it's a slow, quiet erosion of value that can catch even seasoned traders off guard. Understanding these early warning signals is crucial, especially now, as the U.S. economy faces heightened volatility, inflation pressures, and uncertain policy shifts. This information matters right now because millions of Americans rely on their investments for retirement, education, or financial security. If you're a beginner or intermediate investor, recognizing the initial stages of a market downturn can help you protect your assets before damage becomes irreversible. By the end of this session, you'll be able to identify key indicators that suggest a crash is underway, allowing you to make more informed decisions and safeguard your financial future. But to make smart decisions, you first need to understand the economic landscape we're dealing with. The stock market crash has already begun, and many investors haven't noticed it yet. Recent data from the Federal Reserve shows that inflation remains stubbornly high at around 4.1% annually, well above the target rate of 2%. This persistent inflation has led the Fed to raise interest rates multiple times over the past year, with the benchmark rate now sitting between 5.25% and 5.5%. Higher interest rates increase borrowing costs, slow economic growth, and put downward pressure on stock prices. Meanwhile, the Federal Reserve's balance sheet reduction and tightening monetary policy are contributing to a cooling housing market, with new home sales down 15% year over year, according to the Census Bureau. Rising mortgage rates, now averaging over 7%, make homeownership less affordable and signal a potential shift in the economic cycle from expansion to contraction. Additionally, the labor market, as reported by the Bureau of Labor Statistics, shows signs of slowing, with job growth decelerating and unemployment inching up slightly. All these factors, rising rates, elevated inflation, declining housing activity, and slowing employment, are interconnected and suggest that the market is entering a phase of contraction. These conditions often precede or accelerate a broader market downturn, even if the decline seems subtle at first. Recognizing these signals early is crucial for protecting your investments and preparing for what's to come. With that context in mind, let's break down the strategy you can actually apply. The stock market crash has already started, and many people haven't realized it yet. The key to understanding this process is to recognize how market declines happen gradually and silently, often before anyone notices. When investing, it's important to know that markets don't drop all at once. Instead, they begin to decline slowly over time. This is called a slow erosion of value, where the worth of investments gradually decreases without obvious signs. One way to think about it is to imagine your investments as a balloon slowly losing air. At first, it's barely noticeable, but over time, the air escapes quietly. This process is driven by a combination of factors like rising interest rates, economic slowdown, and political uncertainties. These factors make borrowing more expensive, reduce consumer spending, and cause companies' profits to shrink. As a result, stock prices tend to drift downward, often without immediate panic or chaos. Understanding key terms helps clarify this process. For example, volatility means how much the market fluctuates day to day, and correction refers to a decline of 10% or more from recent highs. Recognizing these signs early can help you make smarter decisions, such as adjusting your portfolio or protecting your savings. By paying attention to these subtle shifts, You can better prepare for the inevitable corrections and even turn the situation to your advantage. The goal is to act before the decline becomes obvious and causes serious losses. Now let's look at a real-world example to see exactly how this plays out in practice. Imagine you bought a house 3 years ago for $300,000 with a 30-year fixed mortgage at 3.5%. Your monthly payment, including principal and interest, is about $1,347. Over time, the property appreciates by 4% annually, so now it's worth roughly $319,200. You've paid down some of the mortgage, so your remaining balance is approximately $250,000. Now suppose the market shifts. Zillow shows home values dropping by 8% in your area, meaning your house's current value falls to about $293,500. Meanwhile, mortgage rates have increased to 7%, making refinancing or selling less attractive. If you decide to sell now, you might receive around $293,500, but after paying closing costs, say 6% of the sale price, you net approximately $276,000. Compare this to your remaining mortgage balance of $250,000. You'd walk away with roughly $26,000 in equity, but that's significantly less than 3 years ago. If the market continues to decline, your home's value could drop further, and with rising interest rates, the cost of borrowing or refinancing becomes more expensive. This scenario illustrates how subtle market declines can erode your investment value over time, even without a sudden crash. Recognizing these signs early helps you decide whether to hold, sell, or refinance before losses deepen. This looks great, but only if you avoid the common traps that ruin deals like this. The stock market crash has already begun, and you might not have noticed it yet. While the headlines scream about crashes and downturns, many investors are unknowingly making critical mistakes that could wipe out their savings or derail their financial goals. Let's look at some of the most common errors and how to avoid them. First, one of the biggest mistakes is ignoring market signals and holding on to risky investments without a plan. For example, someone who bought stocks during a surge and refuses to sell when signs of trouble appear can face significant losses. Panic selling in a downturn is often worse than sticking to a strategy. Second, many investors overpay for stocks or assets without doing proper due diligence. I've seen people buy into fad stocks or hot markets without understanding the underlying fundamentals, only to see their investments plummet when the hype fades. This overconfidence can lead to unnecessary losses. Third, neglecting diversification is a silent killer. Relying heavily on a single sector or asset class, like tech stocks, can backfire when that sector declines. A well-diversified portfolio acts as a buffer, protecting you from sudden shocks. Finally, failing to adjust your portfolio in response to economic changes is a critical mistake. During turbulent times, shifting your allocations and rebalancing can preserve your gains and reduce exposure to risk. To avoid those mistakes, here are the best tools and resources available right now. The stock market crash has already begun, and many investors haven't even realized it yet. To protect your assets and make smarter decisions, you need the right tools at your fingertips. First, check your current financial health with Credit Karma. It offers free credit scores and financial insights that can help you understand your borrowing power and risk exposure. Visit www.creditkarma.com. Second, for investment research and education, Investopedia is your go-to resource. It provides in-depth articles, tutorials, and market analysis to help you understand market movements and make informed choices. Explore www.investopedia.com. Third, if you're considering real estate or want to stay updated on housing markets, Redfin offers real-time property listings and market trends, giving you a clearer picture of property values and investment opportunities. Access www.redfin.com. Fourth, for portfolio tracking and analysis, Personal Capital offers free tools to monitor your investments, analyze asset allocation, and plan for retirement. Visit www.personalcapital.com. Lastly, for news and updates from the financial world, CNBC provides timely market news, expert opinions, and economic reports. Check it out at www.cnbc.com. With these platforms, you'll be better equipped to assess your situation, identify risks, and act proactively. Now that you got the tools, let's talk about the first thing you can do today to get started. The stock market crash has already begun, and many of us haven't noticed it yet. Markets are volatile, and signs of deterioration are everywhere. Rising interest rates, declining home sales, and a shaky economy. But here's the good news. You can start protecting yourself today with just one simple step. Take a moment to check your credit score. It's quick, accessible, and incredibly revealing. Download a free app like Credit Karma or use your bank's tools to review your credit report. Knowing where you stand financially is the first move toward gaining control over your future. This step unlocks a clearer picture of your financial health, helping you spot potential issues before they grow bigger. Starting small creates momentum. Once you see your credit score, you can identify areas to improve, avoid unnecessary debt, and make smarter financial choices. It's about building confidence, showing yourself that even amid uncertainty, taking action is possible. Remember, every long-term success story begins with a single small step. Today, you could take that step toward financial awareness. Whether it's checking your credit, listing your expenses, or simulating investment, each action brings you closer to a more secure future. Stay consistent, stay informed, and you'll be prepared to navigate the turbulent times ahead. Taking that first step today sets the foundation for long-term resilience. Let's see what happens when you commit to small, steady progress. Because in times of change, consistency is your greatest asset. 5 years from now, imagine looking back and realizing that the stock market had already begun its downturn, even if you didn't notice at first. Like a slow-moving tide, the decline was subtle but persistent, eroding the value of many investments. But here's the thing. Those who stayed consistent, who kept their eyes on their long-term goals and adjusted their strategies gradually, came out stronger. 10 years from now, your disciplined savings and regular investments could have grown into a substantial portfolio. Perhaps you own 5 cash-flowing properties by 2035, generating passive income that supports your lifestyle, or you've built a diversified investment account that cushions you against market swings. The power of consistent effort, even during turbulent times, compounds over the years, transforming small, steady steps into meaningful financial security. Looking 30 years ahead, the impact of persistence becomes even clearer. Small, regular contributions, combined with patience, could turn modest beginnings into a robust financial future. The key isn't about timing the market perfectly. It's about sticking to your plan, rebalancing when necessary, and trusting that time and consistency work in your favor. And now that you see what's possible, here's how we wrap this up and take action. Start by reviewing your credit, diversifying your investments, and setting realistic, long-term goals. Remember, the most powerful growth comes from steady, intentional steps taken over time. The future belongs to those who stay committed. So begin today and let consistency be your greatest asset. The stock market crash has already begun, and if you weren't paying close attention, you might have missed the signs. We've seen over 60% of stocks decline, markets quietly weakening, and volatility spiking, all while many investors keep holding on to risky assets without a plan. The Federal Reserve's rate hikes are slowing down the economy and putting pressure on housing and investments. The key lesson here? Recognize the warning signs early, diversify your portfolio, and adjust your strategy proactively. Remember, staying informed and disciplined is your best defense against unpredictable times. Thanks so much for watching and for making progress on your financial journey. Every step you take now builds a stronger future, even in turbulent times. If you found this helpful, be sure to like, subscribe, and comment below. What's your first financial goal for this year? I'd love to hear. And if you want to dive deeper into protecting your wealth, check out our related video on top strategies to safeguard your investments in a market downturn. Stay confident, stay proactive, and remember, your financial future is shaped by what you do today. Thanks for being part of this community. Let's keep growing together.